Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY24 earnings conference call of Elecon Engineering Company Limited, hosted by Share India Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. Now, I hand over the conference to Ms. Khushbu Gandhi from Share India Securities. Thank you, and over to you, ma'am.
Thank you and good afternoon, everyone. On behalf of Share India Securities Limited, I welcome you all to Q3 and 9 months FY24 earnings conference call of Elecon Engineering Company Limited. We are pleased to have with us the management team represented by Mr. Prayasvin Patel, the Chairman and Managing Director, Mr. Kamlesh Shah, Group CFO, Mr. Narasimhan Gupta Raghunathan, CFO, and other senior management team. We will have the opening remarks from the management, followed by the question and answer session. Thank you, and over to you, sir.
Thank you. Good evening and a warm welcome to everyone on the Q3 and 9-month FY24 earnings conference call. On the earnings call today, I am joined with my colleagues, Mr. Ayush Shah, Non-Executive Director, Mr. M. Nanda, Head of Gear Division, Mr. P.K. Bhasin, Head of MHE Division, Mr. Kamlesh Shah, Group CFO, and Narasimhan Raghunathan, CFO. We have uploaded the press release and earnings presentation on the stock exchanges and company's website, and I hope everyone had an opportunity to go through the same. I will start with industry and business overview, and then we'll hand over the call to Kamlesh, our Group CFO, to discuss the financial performance of the company for the quarter and 9 months ended December 2023. The global economy has shown some signs of recovery, such as easing inflationary pressures and advancements in artificial intelligence. Despite these positive developments, the pace of global trade remains sluggish, financial conditions remain stringent, and widening of geopolitical tensions with ongoing conflicts such as Russia's Ukraine war, strained China-US relations, and notably the conflict between Israel and Hamas, contribute to the complex global trade and supply chain. The IMF anticipates a slight decline in global economic growth in 2024, projecting a rate of 2.9%, down from 3% the previous year. On an optimistic note, the Indian economy demonstrates resilience in the face of global uncertainty. According to the IMF, India's GDP is estimated to grow at 6.3%, propelled by heightened domestic demand, increased exports presence, and robust expansion in both the manufacturing and services sectors. Moving to the business overview, Elecon Engineering stands tall as the integrated solution provider, leading its way in manufacturing of industrial gears and material handling equipment, serving as one-stop valuable solution provider to diverse set of customers and industries. Being a pioneer in the industrial gears, we have positioned ourselves as one of the largest manufacturers of industrial gears in Asia. The company's leadership position can be attributed to its diversified product portfolio catering to multiple industries, best-in-class quality products, with low lead time, customized solution provider to different class of customers, and state-of-the-art in-house R&D capabilities to enhance and develop new and improved solutions for the customers. The company remains steadfast in commitment of exceptional quality and timely deliveries. To stay at the forefront of technological advancements, we consistently introduce new products with enhanced technology, ensuring best-in-class products in the industry. Our team is devoted towards continuous improvement and addition of product portfolio, particularly in gearbox technology, with a focus on delivering cutting-edge solutions. Recognition from our valued customers and other distinguished acknowledgements stands as a testament of our exceptional quality we consistently deliver. Now moving on to the quarterly segmental developments. Firstly, on gear division. Our ability to evolve with the changing industry needs, steering towards tailor-made solutions, has enabled us to expand our wallet share among existing customers while successfully onboarding new clients across geographies. Our domestic operations have demonstrated robust demand across diverse sectors such as steel, cement, power, and sugar, with a promising outlook for the future. We continue to maintain a leadership position in the domestic market. Our strategic approach involves actively seeking opportunities in niche industries. Talking on the overseas performance, we are delighted to share that we have signed 4 more OEM contracts, bringing our total to 10 OEM contracts in the overseas market. This underscores the growing acceptance of our products and high level of service we provide. Our commitment to growth is evident by continuous expansion of our network, rigorous efforts for business development, and intensified branding efforts. Coming to material handling division, we would like to highlight that the Indian capex cycle is on an upward trajectory and continues to show a positive outlook. A surge in order inflow for the supply of equipment is a result of order wins across diverse sectors. Notably, also like to highlight that we have recently won orders in the steel and cement sectors amounting to rupees 173 crores. Our performance in segment has been complemented by a growing aftermarket business. Through improved process efficiency and a more favorable product mix, we are seeking an uptick in profitability. Moving to the financial aspects, we had mentioned our revenue guidance of rupees 2,000 crores for FY24, which we are expected to reach in spite of challenges due to current geopolitical scenario, as well as softening of the steel-based raw material prices. We expect our EBITDA margins and in absolute terms will remain 24% plus. We shall provide FY25 revenue and EBITDA margin guidance in Q4 FY24 earnings call due to the current geopolitical scenario. General election in India, intensifying ongoing West Asia unrest, impacting supply chain and customer sentiment. However, we are committed to providing further clarity on this guidance as we gain more insight during the next quarter. Our commitment remains steadfast in adapting to external factors and ensuring transparent communication as we navigate these challenges. Lastly, at Elecon, we take every possible step to create a greener future and put emphasis on sustainability. We believe we have the power to drive positive change, contribute to a more sustainable future, and create long-term value for our stakeholders. With this, I would like to hand over the call to Kamlesh Shah, our Group CFO, for financial highlights for Q3 and 9-month FY24. Over to you, Kamlesh.
Thank you, sir. Good evening, everyone, and a very warm welcome to our Q3 and 9-month FY24 earnings call. I will now take you through the highlights of financial results for Q3 and 9 months FY24. Our consolidated revenue from operations for the quarter ended December 2023 stood at rupees 474 crores as compared to rupees 389 crores in the same quarter last year, a growth of 22% on year-on-year basis. The domestic market accounted for 73% of the revenue and balance coming from overseas market. EBITDA for Q3 FY24 stood at rupees 120 crores, growing 36% from Q3 FY23. The EBITDA margin for the quarter stood at 25.4% owing to better product mix and process improvement initiatives undertaken. PAT margin for Q3 FY24 stood at 19.1% as compared to 16.1% in Q3 FY23, registering a significant improvement of 300 basis points. For 9 months ended December 2023, consolidated revenue from operations stood at rupees 1,373 crores, registering a growth of 24% on a year-on-year basis. EBITDA margin stood at rupees 339 crores, registering a growth of 38% as compared to 9 months FY23. EBITDA margin for the period stood at 24.7%. The PAT for the period stood at 252 crore, a growth of 49% on a year-on-year basis. Moving to the segment-wise performance, Gear Division accounted for 86% of the revenue, while 14% was contributed by MHE Division in Q3 FY24. In 9 months FY24, 87% of the revenue was contributed from Gear Division, while 13% was contributed by the MHE Division. Talking about the gear segment, consolidated revenue from operations stood at 409 crore as compared to 329 crore, a growth of 24%. Revenue from 9 months ended December 2023 stood at 1,192 crore, up by 26% on YOY basis. The EBIT for the quarter stood at rupees 111 crore, impressive year-on-year growth of 48%. The EBIT margin for Q3 FY24 stood at 27.2% compared to 22.9%, reflecting a sustainable improvement of 435 basis points. EBIT for 9 months FY24 stood at rupees 310 crore as against rupees 210 crore in 9 months FY23, reflecting a growth of 48% on YOY basis. The EBIT margin for 9 months ended December 2023 stood at 26%, registering a growth of 380 basis points. The order intake for 9 months FY24 stood at 1,189 crore, up by 16% on YOY basis. Order in hand is rupees 572 crore as of December 31, 2023, highlighting the demand across sectors. Moving on to MHE Division, revenue for the quarter stood at 65 crore as compared to 60 crore in corresponding quarter last year, growth of 8% YOY. Revenue for 9 months ended December 2023 stood at 181 crore, registering a growth of 14% on YOY basis. EBIT for Q3 FY24 stood at 12 crore, registering a growth of 38% YOY. The EBIT margin stood at 18.5% as against 14.6% in Q3 FY23, a substantial improvement of 319 basis points on year-on-year basis. The EBIT margin for 9 months ended December 2023 stood at 20.6%, an improvement of 1030 basis points on a YOY basis, primarily on account of better product mix. The order inflow during the 9 months ended stood at rupees 249 crore as compared to rupees 177 crore in 9 months FY23, up by 41% on a YOY basis. The open orders as on 31st December 2023 stood at 219 crore. Furthermore, our total consolidated order book, including both divisions, experienced order inflow of 1,438 crores during 9 months FY24, and the total open orders as on 31st December 2023 stood at 791 crores. Now, highlighting a few developments during the 9 months ended December 2023. As mentioned previously, we are pleased to announce that we have signed off 4 more OEM business agreements. This brings our total overseas OEM business agreement to an impressive number, that is 10, making significant progress in the expanding our partnership. We anticipate commencement of commercial production in FY25. MHE division continues to win big orders for product supply. We have recently received 2 orders from steel sector and 1 order for cement sector, aggregating to rupees 173 crore. We continue to make progress in recovering funds through arbitration awards. As of 31st December 2023, we have received rupees 37.2 crores out of total awards of 63 crore. Negotiations for the remaining amount are currently in progress. Furthermore, we have initiated fresh arbitration proceedings with a total value of 31 crore during Q1 FY24, outcome of which may take 1 to 2 years. We are confident of a positive outcome. On this, I would like to open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Rati from Equitas Investments. Please go ahead.
Thank you for the opportunity, sir. So my first question relates to the Red Sea crisis that is going on and the impact that it carries on the delay in shipment and cost.
I would say that right now we are just shipping the orders that we have received. Yes, it is taking us, our products are reaching 2 weeks later to our clients in Europe, and if it is United States also, it would be 2 weeks additional time. Though the customers are complaining that it is taking 2 weeks longer, however, it has not seen a significant impact on reduction of orders or cancellation of orders.
Sir, does it carry any cost impact relating to it?
Cost impacts are definitely coming in. We are transferring those costs to the clients in general because considering the fact that the freight as it is was being paid, it is not inclusive in the price of the gears. So they are paying the extra cost. No one likes it, but still they are paying it.
Okay, sir. And sir, just now you mentioned that we still hold the revenue guidance for 2,000 crore for financial year 24. Given that in 9 months we have clocked close to 1,370 crores of revenue, and there's a continuous decrease in the order book volume from transmission division. So do we still hold that 2,000 crore revenue guidance?
Yes, as of now, we are still continuing with 2,000 crores. We are reasonably confident. However, as I have mentioned also in my speech, that there are challenges because of the reduction in steel prices, as well as the geopolitical situation existing today with 2 wars going on and the Red Sea issue. So we are reasonably confident because we are going to try our very best to reach the golden figure of 2,000 crores, and we will continue to strive for that.
Okay. And so my last question relates to the extra 4 OEMs that we have signed overseas. Sir, any estimated business volume guidance for that? Like you mentioned for the 6 overseas last time, that 5.5 million euros would be coming from that.
Yes. We are anticipating 6 million euros of business coming in from it. However, it is difficult to say right now because once right now we are in the testing phase where we would give them prototypes and they would put them on test. After which, the existing supplier, his scope would reduce and ours would increase. So over a period of time, it will keep on increasing. So it is very difficult to ascertain. However, our rough estimates are about 6 million euros.
Sir, the 6 million is incremental for that 4 OEMs, or this is of the entire 10 OEMs that we have signed?
It is all 10 OEMs to start with, and then as I told you, over a period of time, it will keep on increasing.
Okay. And sir, any idea on when do we plan to commercialize it?
2025.
Okay. Thank you so much, sir.
In Q3, we are expected to start the commercial production.
Commercial production will be in Q3 2025. However, as I told you, 6 million, it will take about 12 months to.
Okay. Thank you so much, sir.
Thank you.
Thank you. Our next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Hello.
Yes.
Yeah, sir, congratulations on the great set of numbers. Couple of questions from my side. Point number one, you highlighted about the scope of work from 10 overseas OEMs that you expect at about $6 million eventually. In light of the fact that our guidance over the next few years is revenue share of 50-50 between how much can eventually this 10 OEMs add in that 50-50 target, let's say over the next about 3-4 years? Second question is, you highlighted about some of the, vulnerability or volatility in terms of our overseas business. But in terms of domestic business in FY25, how are things looking like there in terms of revenues? And third question is on our MHE margins, which now are almost inching very much near to our transmission division margins. So on a steady state basis, if there are no more write-offs in line with our strategy of not taking PSU business, are these sort of margins which are sustainable in MHE business?
You've asked so many questions, so let me start right from the beginning. First of all, yes, the 10 OEMs would constitute about 6 million euros to start with. Okay. We presume that we will reach that figure within 12 months of commencement of normal production after the prototypes have been accepted. And we also see a good traction among our marketing people abroad, not only OEM but replacement business, because right now the companies do not want to invest a sizable amount in new machinery and equipment. So they're more interested in continuing with the old equipments and still updating them to some extent. Therefore, there's a good potential for replacement business that we see right now. So considering all that factor, we are confident that if things go positively, we will be able to achieve our targets of 2,000 crore. And as long as material handling division is concerned, the margins are almost reaching close to the gear division. We expect those margins to be sustained over a period of time because we are picking and choosing the customers, and we are picking and choosing orders where we get reasonably good margins. And therefore, though our turnover has dropped from the initial stages when we were doing contracting business, but we are focusing more on the bottom line. So we believe that
on the MHA side, are these margins a function of purely operating leverage, or in the market there is a demand-supply mismatch also, which is helping us price them better?
No, it's not the mismatch. It is basically our business constitutes replacement, which is the after sales, as well as new requirements for new projects which are coming up. So we are confident that we will be able to maintain those margins.
And just in continuation of the previous question about European OEMs, 6 million euros is the peak, order value possible, or this is, where we start, and eventually this 6 million euros can be in OEM space can be meaningfully higher number?
It is a starting figure. We believe that it will open up more avenues for us with the 10 OEM contracts that we have signed, plus it will also open up doors for their competitors to whom we can also deal with. So all in all, we believe that over a period of time, this 6 million will expand to a reasonably large number.
Domestic market, any commentary for next year?
Domestic market, I believe, is holding grounds, and the way things are going, I'm reasonably positive that it will keep on growing at least at the 6+% GDP growth, which we expect it to continue, at least for another 1 or 2 years, if not more. We are seeing a good amount of traction in our business, especially in cement and steel, and we believe that that may rub off to even various other industries.
Sure, sir. Thank you, sir. That's it from my side.
And next year, even sugar looks to be promising.
Okay. Thank you so much, sir.
Thank you.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Garvit Goyal from Nvesh Analytics. Please go ahead.
Hi, am I audible?
Yes, sir.
Good evening, sir, and congrats for a good set of numbers. My question is, do you see any headwinds or any slower growth rate in FY25, given that those geopolitical tensions you mentioned, including those Red Sea issues and falling order book in the gear division?
I have a different approach to two things. I believe the worst has already happened, and now things will start improving, because if you look at the Russia-Ukraine war, how long can it further last? Okay, it can't last forever. Similar is the situation with the Hamas war, and if the Hamas war gets diluted, then the Red Sea issue also should get diluted. So I am reasonably positive that over a period of time, we are already seeing the worst scenario. Hopefully, things will improve.
Okay, sir. And the presentation, that is answered. One question is particularly on the railways and metro segment. As far as I remember, in Q1 FY24 Concall segment for manufacturing gears through global partnerships, we are trying to enter into railways and metro segment. So can you elaborate on the opportunities that the company forces in this partnership?
We are still pursuing. We have given trial components as well as products to the OEMs. However, the process is a slow process which is continuing. As of now, it is going extremely slow. But we are hopeful that we will be able to improve the scenario in the future.
Okay. And on the material handling equipment side, so have there been any orders from railways for product side like wagon tripler?
Yes, they happen to come in on a continuous basis from various clients which are from the cement power sector as well as steel. So that is an ongoing product that we keep on selling.
Understood, sir. And on the export front, currently our export percentage is 27. So and you have the guidance for export of 50% by 2030. So to which major countries in the company currently targeting?
It's difficult to say because, as I told you, we have focus more on the United States and Northern America. We also see a good traction in South America. Europe is also showing promise. So it is difficult to say, and it will vary from year to year. So the intention is that you keep on selling products in various countries. And if you do not focus only on a particular region, it is better because that will help you hedge well against recession when a recession hits India. Because then your 40 to 50% of your turnover is coming in from exports. And hopefully while India goes into recession, hopefully there are good times in other countries of the world.
Understood, sir. And on the order book front, currently we do have an open order book of somewhere around 800 CR. So how do you see the order book shaping up in the upcoming quarters?
Normally what happens is by the year end, you see an increase or a surge coming through. So we are hopeful that the figures will improve over in the last quarter.
Understood, sir. That's it from my side, sir. All the best for the future.
Thank you.
Thank you. Our next question is from the line of Mudit Kabra from Elara Capital. Please go ahead.
Hi, sir. First of all, congratulations on OEM additions.
Mr. Kabra, may we request you to use your handset, please?
Is it better now?
Yes, sir. Please go ahead.
Great. Thank you. Firstly, congratulations on OEM additions in your
Thank you.
Could you tell us which are the sectors where we have added these 4 new OEMs?
So these are from packaging, steel and plastic industry.
Okay. And apart from that, sir, if we add up Q2 and Q3 inflows this year and last year in the industrial segment, we see there is a flatness in the quantum of order inflow. And we also, if I can recall, in last in this Q2, we mentioned that there is some spillover in order inflows. So is it fair to assume that the growth in inflows in industrial segment this quarter Q3 is majorly on account of the spillover which is getting through in Q3?
Sorry, would it be possible for you to repeat that because somewhere down the line we could not hear it properly.
Okay. Sir, if we add up Q2 and Q3 inflows in this year and the last year, it is largely flat. And in last quarter, Q2 FY24, we mentioned that there is a spillover because of delay in export orders inflows. So is it fair to assume that the order inflow in the industrial segment this quarter is on account of those orders coming in this quarter, like the spillover coming in Q3?
No.
These are fresh orders?
Yes.
Okay.
See, our deliveries are extremely fast. So the time that we take to process and execute is very fast. So, you see a big consumption that takes place.
Okay, and similarly,
Yeah.
yeah, continue.
No, please go ahead.
Yeah, okay, and similarly, there is no impact on revenue recognition also in this quarter due to the spillover impact?
No, there is no.
Okay, got it. Lastly, sir, on the market share in Q3 versus last year Q3 in the organized industrial gears?
Generally, we don't do on a quarter-on-quarter basis. We work out our market on an annual basis.
Okay.
Because what happens, some of the figures are not available on a quarter-on-quarter basis.
Got it, sir. Got it. And do we have the revenue mix between the customized and the standard product this quarter?
Yeah, this quarter, 55% is from engineered product, that is customized product, and 45% from catwalk product.
Perfect. Thank you so much, sir, for this information. All the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Ashutosh Garud from Ambit GPC PMS. Please go ahead.
Hello, sir. Am I audible?
Yes, sir. Please go ahead.
Oh, yeah. Hi. So, first of all, congratulations for a good set of numbers. So, my question is slightly broad-based. So, just wanted to understand. We've seen the last whole decade, as far as Elecon engineering is concerned, the top line has hovered around 12.
We can't hear you now. I think you got disconnected.
Okay. Am I audible now?
Yeah.
Yeah. Sorry. I was saying that we have seen that the top line for Elecon engineering has been hovering around 1,500 odd crores to 1,200 odd crores for the whole decade. And now we have seen recent few quarters of good traction. So just wanted to understand, yes, you mentioned some kind of caution in the near term because of the geopolitical aspects. But from the next 3 to 4 years perspective, do you think that we are really getting into a capex cycle which is much more sustainable? Because what we are seeing that even your operating margins have improved dramatically in the last 2 years. So just wanted to have a broad sense on the next 3-4 years journey going ahead, and then maybe I can come on my second question.
See, if you look at it from where we started where material handling and gear business used to be 50-50. Okay. Today, the material handling business is hardly less than 20%. And the balance is gears. So there has been a tremendous shift in the turnover coming from material handling as well as gears. And the gear has always been giving us better margins up till now. And in MHE, because of our change in strategy from contracting business to product selling as well as the after-sales market. So we have been able to reduce the top line, but slowly and gradually we want to ensure that the bottom line is extremely healthy, just like what you would find in gears. So the whole transformation has taken place, and slowly and gradually over a period of time, we have been able to increase the turnover of both gears and material handling with high profitability. Going forward, the way we see it is the domestic traction plus our focus on exports. The export focus are tie-ups with OEMs and other possible companies in Europe as well as United States would give us substantial traction going forward, and we believe that we will be able to sustain the growth. There is a constant challenge which exists today in Europe and United States, where their local costs are going up tremendously, and where they would like to offload various products to the companies in Asia. And that is where we see a good potential coming our way. And that is the reason we are confident that we will be able to sustain this growth over a period of time. Plus, we have not yet as a company or as a group looked at inorganic growth. There again, the potential also is high. Okay, because there are companies abroad, especially in the Western world, where they have issues of margins. The margins are negligible, and where unless they bring in a foreign investor from the Far East or Asia, for them to sustain becomes difficult. So this scenario is very favorable to us, and we see a great opportunity going forward.
Okay, great, sir. Thanks for that elaborate answer. And just coming to the near term, so when we are talking about 2,000 crores of top line for this financial year, so that actually, I mean, some of my fellow callers, I mean, I also wanted to understand the same thing. So are we expecting a decent amount of execution in the Q4? Because at that run rate, we should be clocking in the excess of around 600 crore kind of a top line. So if you can just throw some color on, is there some delay in execution from this quarter to the next quarter, or any other aspect which is playing out here?
See, I always say that mechanical engineering companies are like the T20 teams, because the last 5 overs are very critical. Similarly, Q4 for all the engineering companies, the turnover always jumps up to a large extent. So that is the reason why we believe that, going forward, we will be able to do a much higher turnover in the last quarter.
Okay. Thank you, sir. Thank you, and all the best, sir.
Thank you.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, may we request participants to limit their questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks for the opportunity. Congratulations, President, for good numbers.
Thank you.
Sir, but just one thing I wanted to understand, the way power sector is investing now, thermal power, government is very keenly want to expand coal mining, coal gasification. So how internally we are prepared? Because we have stopped this EPC, that I understand, but in terms of product, our capability, our team building. So on MHE, how you want to prepare yourself? Because the opportunity will be definitely there.
Yes, you are absolutely right, Sunil. Right. The opportunities now are coming up, and they are coming up in a slightly different way than before. But, I completely agree with you that India will not be able to completely move away from coal and mining, especially coal mining. And therefore, the potential not only exists in mining coal, but also in the power sector. And we are tightening up our belts because, as you know, we were quite largely dependent on the power sector, especially in material handling. So we looked upon it as an opportunity, and we are putting up a team together to evaluate and execute this as and when the opportunity arises.
Okay. And sir, one more question is on this internal development on some different type of gears. We were, I think, developing speed gears. So, and many internal things we do always continuously. So, on those things, if on transmission side, if you can talk whatever qualitative aspect of Elecon internally, what we are doing.
Yes, Elecon is continuously developing not only new products but also new lines for the future. High speed is one of them, okay, where we have internally put up an entire program where we had involved consultants and guides who helped us develop all this. We have successfully developed it. I cannot name or cannot give you the names, but we have successfully developed products for some very important customers. Mm-hmm. And we believe that will give us a good, business going in the future. This is as long as high-speed gears are concerned. We have developed also very special kind of couplings, which we will be putting up in the market very, very soon. So there are new aspects that we continuously keep on striving to develop and put them on the market, because that is the way to go forward. We have been doing this in the past and we will continue to do in the future. And some or the other, sometimes you hit a lottery with it, which means though the potential may be low to start with, but it gives you tremendous opportunities in the near future.
Right, sir. Thank you very much and wish you good luck.
Thank you.
Thank you. Our next question is from the line of Akash from Dalal and Broacha Stockbroking. Please go ahead.
Very good evening, sir, and that's a great set of results. So my first question to you would be on the capacity utilization that we have operated at in this quarter.
Capacity utilization 76% is approximately 76%.
Okay, sir. And sir, what would be our scope to improve from here? What would be our peak in terms of utilization?
See, I would not put it as a cutoff area, because today Elecon is doing almost, I would say, 80 to 90% of the manufacturing in-house. So if you do subcontracting, the potential would be even larger. Okay, but because of maintenance of quality, high standards, plus our own capability to do things, we have been doing them in-house. But if you require, subcontracting can also increase the capacity to a very, very large extent. I would say 80-85% would be a reasonable amount internally to pursue. And as I told you, subcontracting, even additional capex, which we are doing over a period of time, all this would increase the capacity.
Got it, sir. Sir, if you could give some color on the capex that we are planning to do in the balance part of this year and in the next couple of years.
Sorry, can you repeat that, please?
Sir, if you could give some color on the capex that we are planning to do in the coming quarter and as well as in FY25.
This year we are already spelled out a capex of 100 crore, and we are just going to achieve the capex out of nearly 80 to 90 crore rupees from this year. And if you see over the period of 3 years, we have spelled out our capex plan is 300 crore in the 3 phases. 100 crore we already spelled out and we are doing now. Another 100 crore and then the next 100 crore will be based on the revenue estimation. We are just going to implement that. And further, we may require to accelerate that capex, considering the long lead time for supply of equipment, which is a sophisticated and automated equipment.
See, approximately it works out to be 100 crores per year for the next 3 years. This is going to be done from our own internal resources. There is going to be no external borrowing. Okay. As well as I told you, that would not only increase the capacity, but also would be to improve the quality and to sustain the productivity that we have today, or even better.
Got it, sir. So, sir, out of the 100 crores for this year, we have just done around 26 crore for the 9 months, right? So balance is going to be done in the Q4.
Some are already done, and because some are given the advance to the supplier, where the machines are expected the delivery of that this Q4, and some of them are done next year Q1. Total, we already spent 52 crore.
Got it. And one more question from a more long-term point of view.
I request you to rejoin the question queue for more questions, sir. Thank you. Our next question is from the line of Gunjan Kabra from Niveshaay. Please go ahead.
Congratulations to the entire team for a good set of numbers. So my first question is
Sorry to interrupt. May I request you to use your handset, please?
Yeah. Is it fine now?
Yes, ma'am.
Yeah, much better.
Yeah. Hi. So wanted to understand that for the next year, with the current demand environment and the inflow that we see, are we can we expect around 20-25% of the growth that we have been doing since last 1-2 years, and we can continue doing that with the current capacity and the demand scenario? So what's your take on that?
See, because of the geopolitical situation, we are assessing it very minutely, and thus we normally do this exercise in the last quarter. So this exercise will be done shortly, and we will be coming up with our projections for the next year and the tentative projections for the next year in the next Concall that we do in the last quarter, after the last quarter.
Further to add, because this is the general election period that as such we are aware, and considering the other geopolitical scenarios and general election in India, some the process will be slowed down administratively. We are just putting we are fine tuning the numbers, and we'll just work out with a more accurate number in our Q4 earnings call.
Okay, so next quarter would be a better time for you to guide us.
Yeah.
Okay. So next question I had is, how much is the after-sales service in the MHE division? So suppose if you're doing around 200-250 crores in a year on the MHE side in terms of revenue, then what's the after-sales that we have every year? What's the percentage of that?
In MHE, we have, if you see 9 months, we have did 39% is from aftermarket.
So 39% is aftermarket, but I'm asking if suppose, for example, if you execute around 250 crores of the revenue, if you do around 250 crores of revenue in the MHE division, then how much of that revenue is after sales that, percentage of the total order that you execute comes in form of after sales service? Is that a parameter to understand, is what I wanted to understand.
Because in material handling equipment, most of the things are required scheduled maintenance kind of activities, and we cannot anticipate to what it will be. If we expect only purely on the service side, it will be 50% of the revenue over the life of the product will be after sales market.
Okay. And just last question. So I always ask you this, that, in defense side, we haven't received on the marine gas because we have an edge on that. So defense segment as a whole in the industry is doing well. So can we expect for gas the number to inflow in the next year, or how do you see it, the defense segment? And also, are there any sectors where we have a high margin, where we can demand higher margin, maybe, in steel or cement, or is it the same in all across the sector?
The margins vary from project to project. and from customer to customer. So it's very difficult to give you an answer on that. As long as marine is concerned, marine orders come in spurts, which means they come and then after a while there is a gap and then again they turn up. But we are hopeful that a reasonable good quantity should be expected in the next year.
Okay. And of the current order book, how much is the customized and how much is standard orders? Can we have a highlight on that?
Yeah, 55% is coming from customized gears and the balance is coming from catalog gears.
No, that we have done in this quarter. I'm asking for the current order book of 525 crores that we have right now. So is it the same number that is there or is it different?
It would vary slightly.
5% plus or minus.
Yes, 5% is the variation that one expects from quarter on quarter. There could be fluctuations of those kinds. It also depends on how much of the orders after receipt are produced in that particular quarter.
Okay, got it. Thank you so much and good luck to you and the team.
Thank you.
Thank you. Our next question is from the line of Deepak Purswani from Swan Investments. Please go ahead.
Yeah. Good evening, sir, and congratulations for good set of numbers.
Thank you.
Just wanted to understand in terms of the export market, if you can throw some light in terms of the growth in the 9 months, because if I'm looking into the performance between the console and standalone, in the 9 months, the difference between them in terms of revenue is 258 crore, which is a 8% year-on-year growth. So how should we look into these numbers? And in terms of the export market, I think at the beginning of the year we were targeting somewhere close to 500 odd crores. So are we on track to achieve these numbers?
Yes, we are on track to achieve these numbers.
So we are expected, some in Q3 it was due to holiday period, both in India as well as overseas, and further that escalation of Israel Hamas, which has impacted the transport. We are expected that in Q4 we are able to achieve the target what we have spelled out.
Okay, and sir, can you please also share numbers for the 9 months in terms of the growth for the export market?
Growth for the export market?
Yes.
You want the 9 months export figures for the 9 months? Is that what you want?
Yes.
So we have achieved 338 crore of our overseas business plus export from India. Against that, last year we did 326 crore during the same 9 months period.
And sir, in terms of the order intake for the export market, I mean, in the current order book, how much is the order intake for the export market?
80 crore. Indian rupees 80 crore.
Okay. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Naisar Parekh from Native Capital. Please go ahead.
Yeah, hi. Thanks for your question. The first one was
May I request you to use your handset, please? You're not audible.
Yeah, sorry. Is this better?
Yes, sir. Please go ahead.
Okay. So directionally, we are at 25% EBITDA margin. This is obviously the highest for us. So going forward, how do you see these margins? Do you think that we've peaked and we'll reinvest back, or is there further scope to go up, or how should we look at the margin trajectory?
I think between 23 to 24% is a sustainable margin going forward. 23% minimum is a sustainable margin going forward for us, and we can optimize this to 24%.
Okay, got it. And second, just in terms of our capex plans, I think you mentioned 100 crore each. But other than that, do we have to consider a larger capex plan, in the next, taking a 3-4 year horizon, and how do we think of that?
We have no other plans except consuming this 100 crores each for the next 10 years.
Okay, and at that capacity, at what capacity would that leave us generally in terms of revenue or something?
We are expected that with this, it should take us to at least 2,500 crores. And if required, if additional resources are required, we can even subcontract.
Understood. Got it. All right. Okay. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, this will be the last question. Our last question is from the line of Yashi Lohia from the Microcap Minute. Please go ahead.
Thank you for the opportunity. So I just have two questions. So basically, the recent orders that you have got from the MSC division.
Please.
Is it better now?
Yes, ma'am. Please go ahead.
Yeah. So thank you for the opportunity. I wanted to ask you the recent orders that we have got from MSC division. 134 crores in the steel sector and 39 in the cement. So does our current order book include these, or when are we expecting it to realize?
Now that last order which we received in January, which is of 83 crore, is not included in our order book, open order book position of 791 crore as of 31st December 2023. If we include that, my total order book position will be 874 crore.
Okay. And so when are we expecting it to realize?
When are we expected to? Sorry, can you repeat that again, please?
When are we expecting it to realize?
Realize?
When can we expect these? Yes.
Just a second.
So it will be realized by Q3 next year.
That is invoicing.
And okay. And if I see the gross profit margins this quarter, it has decreased by 110 basis points year on year. So is this because of can you share some light on why has happened?
It is because of the product mix, because we are due to change the product mix, 100 to 150 basis points will be always a plus or minus. We always give the guidance on the average out based on the annualized basis.
It will even out before the end of the next quarter. It is just that it depends on what orders you have executed and what equipments are being manufactured, which varies the margins.
Okay. Thank you so much, sir. That was so much.
Thank you.
Thank you. That was the last question of the question and answer session. I would now like to hand the conference over to the management for closing comments.
Thank you for participating in this call and expressing your interest in our company. We are strategically positioned to leverage opportunities in the domestic market and are actively exploring avenues internationally. As we progress on our path, we aim to reach new heights and achieve significant milestones. If you have further questions, please feel free to reach out to SGA, our investor relations firm, or our CFO, Mr. Narasimhan Raghunathan. Your participation is greatly valued. Thank you.
Thank you. On behalf of Elecon Engineering Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.